When we look at the CPI number this morning and other prints recently, does it make you concerned that the Fed might be behind the curve?
I'm watching very, very closely. I've been encouraged that in the last FOMC meeting, there's more clarity on their focus on this issue. I think the facts around whether or not inflation will be transitory also depend on where we go, just not with monetary policy, but also fiscal policy from here. There's no question there's inflation, not just labor inflation, but also in supply chains. I'm hearing that from CEOs as I'm out traveling and talking to clients. I think we'll have to watch it very, very carefully, but I know the Fed's extremely focused on the issue. And so the decisions we make from here obviously will have an impact.
A lot of focus today, for obvious reasons, on your asset management performance. Revenue almost double what was expected, more than double what was expected, and a large part of that was equity investments. Interested that you weren't just having unrealized gains, but realized gains in that area. You were selling down some of those positions. I think the word you used was harvesting them. And you said because the environment is supportive. Is that another way of saying that markets are a little bit excessively priced at the moment and you took the opportunity to sell down the positions?
When we had our investor day a year and a half ago, we laid out that one of our principal goals for this segment of our business, the asset management business, besides growing it meaningfully as we looked ahead, was to shift the mix of the way we did business. We had a business that was capital dense. We did a significant amount of on-balance sheet investing. There's a history as to how we got there. But as we look at our alternatives business, and at this point, we supervise over $400 billion of assets and alternatives. As we go forward, we want less balance sheet intensity in that business. And so we had stated that we would move in that direction during the investor day. We've been executing on that. To execute on that, we have to monetize investments when we can. We have the high-class problem of markets going up, and so growing some of that balance sheet even while we're selling. We tried to outline that today in our presentation. I think that the market is looking at the robust economic recovery we're having, and it's pulling forward some of that recovery. We'll watch that.
Is it a bit richly valued, the market at the moment?
Richly valued, it depends on where the economic recovery goes from here. Obviously, and you guys are reporting on it, earnings momentum is quite strong. And I think the market is catching up with that strong economic recovery. The big question will be, what do we see in 2022 and 2023, and how will the market rebalance to that? At the moment, the market's telling you that growth is very, very robust. The bond market's actually telling you that we should be worried about growth. The bond market at the moment's not worried about inflation. So I think we have to watch this closely. We clearly have had an accelerating economic environment. As we've seen those gains in our portfolio, we are monetizing where we can because we'd like a less capital-intensive asset management business, but we're making progress on that. And we continue to raise a lot of money from our clients. As we stated on the earnings call, we've raised over $75 billion in new fund capital since we laid out our plan at our investor day. So we're making real progress in that business, and I'm really pleased with the performance.
Shepard Smith here. Thanks for watching CNBC on YouTube.